Welcome to RLA Radio. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. Joining me in segments 2 and 3 of today's program is returning guest, Mr. John Rubino. John writes a Substack newsletter that we're going to talk about, in particular, an article he wrote about the devaluing U.S. dollar. And what if all the economic data reported today was still reported based on gold? It's going to be a really interesting conversation. That's in segments 2 and 3 of today's program. I would encourage you to stay tuned for that. I do have available for you a special report. It is titled Tax-Free Retirement Income Strategies. The timing is not better to get this information in your hand. Current income tax rates will remain at the current lower levels through tax year 2025. So that's for 2 more tax years, 2024 and 2025, before resetting to the rates that were in effect in 2017 in 2026. So in other words, we go back to the higher rates in 2026. This report gives you some current strategies to consider to reduce your taxes, not only on your income, but also on your retirement accounts like your IRA and your 401k. Go to requestyourreport.com and let me know where to mail the report, and I'll be glad to do so. Economically speaking, where we go from here is really not a mystery. Let me have you think back for a moment to what your history professor told you, and I'll bet it went something like this. Those who don't study history are doomed to repeat it. There are many, many historical examples of government debt rising to a level that exceeds the government's ability to pay it. And here we are again. And almost every time, historically speaking, debt levels rose to unsustainable amounts, the response of politicians and policymakers in charge at the time was the same. What did they do? They created currency to attempt to paper over the debt. That created inflation, which was followed by deflation, which is always the outcome of excessive debt. Now, if you want to know what deflation is, think about the 1930s. Now, today, when you combine government debt levels with private sector debt levels, you have all the ingredients of a perfect economic storm. Let me start here with U.S. government debt. U.S. government debt is simply out of control. Currently, the national debt of the United States stands at about $35 trillion. That's a really tough number to get your arms around. Bottom line is this: every American citizen would have to write a check for about $104,000 to be able to pay off that debt. Now, the reality is not all Americans, in fact, most Americans, are not financially capable of writing a check for that amount. So if we narrow this math down to only taxpayers and exclude the Americans who do not pay income taxes, the national debt spread evenly over Americans who pay taxes would have each taxpayer writing a check for about $267,000 to wipe out the debt. Now, don't shoot the messenger here, but this debt cannot possibly be paid. The $35 trillion national debt of the United States is more than the total economies of China, Japan, Germany, and the UK combined. On top of that, Social Security and Medicare are woefully underfunded. According to a recent report by the U.S. Treasury, these programs are underfunded by more than $173 trillion. $173 trillion is more than the entire economic output of planet Earth. In 2023, total world gross domestic product, total world economic output was about $105 trillion. If you adjust that number for inflation, that's nearly as much as our government has spent on everything since the Constitution was written in 1787. So if we add the official national debt to the $173 trillion underfunded problem of just Social Security and Medicare, we have about a $200 trillion problem. Now, when you couple that with U.S. households and nonprofit organizations having a net worth of $161 trillion, that means we could confiscate 100% of the wealth of U.S. households and nonprofit organizations and still not solve the problem. If we add to that the net worth of corporations have a net worth of about $60 trillion if we exclude financial corporations. So we could really confiscate 100% of the wealth of households, nonprofits, and non-financial corporations and still come up short. And as far as financial corporations are concerned, given the worldwide derivative numbers, the worldwide derivative exposure, those organizations are also upside down. So the bottom line is this: the U.S. government has too much debt and too many unfunded liabilities to ever possibly be fiscally solvent. Now, if you tie in private sector debt is presently about 220% of gross domestic product. That means for every dollar the economy produces, there's private sector debt of about $2.20. Now, let me put that number in context for you. The Great Depression of the 1930s was caused by debt excesses. These excessive levels of debt led to the worst deflationary environment that we've seen in the last 100 years. However, entering that deflationary environment, private sector debt was 140% of economic output. It's now 220%. Alarmingly, private sector debt today is more than 50% higher when measured as a percentage of economic output than it was at the onset of the Great Depression. In 1929, U.S. government debt was 17% of economic output. Today, it's 130% of economic output. So we have approaching what I believe will be a perfect economic storm. Now, does the storm arrive next year, in 5 years, or 10 years? I don't know. However, it's really important to take action now to protect yourself. The Fed has just announced that they will be cutting interest rates again in September. It would not surprise me if it even happened before then, but in September, rate cuts will start. That will inevitably, mark my words, fuel more inflation. However, at a certain point, these excessive debt levels will mean that deflation kicks in, and we have a period of time that will be not unlike what we experienced in the 1930s. So as you're planning for retirement, you want to make sure that you have a strategy in place to deal with inflation, to protect your purchasing power, and you want to make sure you have a plan in place to deal with deflation, which causes the prices of traditional assets like stocks and real estate to decline. Even though we are going to have inflation followed by deflation, because history tells us we will, the what is a lot easier to predict than the when. We don't know when we're going to see this transition from inflation to deflation. So it's important for you to have a plan. And to that end, I am also including, when you request the report, and again, if you're just tuning in, the report I'm offering is Tax-Free Retirement Income Strategies. You can go to requestyourreport.com. Let me know where to mail that report, and I will be glad to do so. But along with that report, I'll also send you a couple copies of a recent newsletter. I'll also send you a copy of my revenue sourcing book, which contains a retirement planning strategy for the current economy. It contains strategies to help you put in place models and tactics to deal with the upcoming inflation followed by deflation cycle. So when you go to requestyourreport.com and request the tax-free income strategies report, you'll also get the revenue sourcing book as well as some other resources. I'll send you a box of what I believe is vital information to have. This is all free and without further obligation. All you need to do is go to requestyourreport.com, and I'll be glad to send you all that stuff. Again, requestyourreport.com. I'll be back after these words with my special guest, Mr. John Rubino. Welcome back to RLA Radio. I'm your host, Dennis Tubergen. Joining me on today's program is returning guest, Mr. John Rubino. If you're a longtime listener to RLA Radio, you probably recognize John as the co-author of the book, The Money Bubble, What to Do Before It Pops. A terrific book written quite a few years ago, but I would say more applicable and relevant today than probably maybe even at the time it was written. John also has a Substack newsletter I'd encourage you to check out. You can check it out at rubino.substack.com. Rubino is R-U-B-I-N-O, rubino.substack.com. And John, welcome back to the program.
Hey, Dennis. Great to talk to you again.
So, John, you recently, on your Substack newsletter, I read a piece that I thought offered a really interesting perspective. I thought we could take a minute in this segment and talk about it. Your piece was titled, A World Priced in Gold. And you went back and said, just pretend it's 1971 and President Richard Nixon made a different choice. Can you kind of jump in from there using that as an intro?
Yeah. One of the really frustrating things about fiat currencies, that is a currency that's not backed by anything and just exists by government decree or fiat, is that governments can create as much of that currency as they want to, and then you get inflation, and that distorts everything, because inflation is like changing the measuring stick that you use for stocks and houses and your wages and things like that. And so it makes it very hard to tell what's really going on. So one really useful way of getting past the distortions of fiat currencies is to go back and look at the price of everything in gold. In other words, if we'd stayed on a gold standard like we kind of were on in 1971, what would the price action of these big things that define our financial lives actually look like? And the answer is they look completely different. For instance, taking stocks. The S&P 500, since 1971, when valued in gold, is unchanged. It's literally at the same level today as it was in 1971, which means if you'd bought a portfolio of big blue chip stocks, based on their prices, you would have made no profits over the course of the last 50 years. Now, the stocks pay dividends, so you would have gotten maybe 2% a year real return on that portfolio. But it's not like if you're looking at it in dollars, you bought stocks back in the 1970s, it looks like you made a ton of money. But what really happened was the dollars you're using to measure your stock portfolio went down in value. So what looks like a big long-term profit actually was not anything in real terms. And let's see, GDP, for instance, it looks like the U.S. economy got much bigger since 1971 to the present. But what actually is the case when you value the U.S. economy in gold is that it didn't grow much at all. It actually shrank a little bit from 1971 to the present. And, all those people who are out there saying, we're in a depression and the economy is actually shrinking, they are actually correct in real terms. In inflation-adjusted terms, the U.S. economy is smaller than it was back when we went off the gold standard. And then, oil, for instance, which defines our economic lives, really. There's a saying that energy is life and life is energy. And it's true. A modern economy can't exist without energy. And oil has gotten more and more expensive since 1971 in dollars. But if you look at it priced in gold, oil is actually down since 1971. Energy is getting cheaper in real terms. And that's part of why it feels like the economy is growing, is because that has made life easier for people in one sense, in the sense that in real terms, energy is getting cheaper. But in a dollar sense, energy is getting much more expensive. So you have two very different views of the energy market. And now, last but definitely not least, housing. What we pay to live have a roof over our heads, is a very important determinant of how well we do financially. And houses have gotten much, much, much more expensive, and so have rents. Rents have gone up along with houses, and that's made life much harder for people who are using dollars to try to buy a house or try to pay their rent. But in gold terms, houses have gotten cheaper over time. We've actually had deflation in the housing market. So anyhow, add it all up, and if we were in a sound money world, if we were using gold as our money, it would feel like we were in a shrinking economy and in a deflationary economy. And that's the reality of the world. The only reason it feels like we're in an inflationary economy where things are getting more expensive is that we have to pay in dollars, which are going down faster than we understand that they are. Because it looks like the dollar is stable and everything else is going up. But what's really happening is the dollar is losing value while everything else is stable in real terms. So anyhow, to sum that up, a fiat currency is a tool for governments to fool us into thinking that they're not mismanaging the economy. Because when our house goes up or when our stock portfolio goes up in dollars, we think we're in a pretty well-managed world, but we're actually not. We're actually in a world where the economy is shrinking and where the value of a lot of other things are actually going down. So that is one more perceptual change that people have to go through to actually understand what's happening in the world right now. And the more you learn about things like this, the more you realize that we're being lied to on a lot of different levels. And those lies are in the service of, the U.S. empire. A lot of people in charge of the U.S. government right now basically want to rule the world. And they use that fiat currency to lie to us about what their true intentions are. And the amount of wealth that we're accumulating seems big if it's in the stock market, but it is actually not nearly as big as we think it is. So we're not as rich as we think we are, and the government is not nearly as honest as we think it is. And the fiat currencies of the world are a tool for those governments to lie to us about what's really going on. So, it's interesting, and it's very sinister in its conclusions.
So my guest today is Mr. John Rubino. Check out his newsletter at rubino.substack.com. John, as you were chatting, just going back to stocks for a minute, you mentioned that priced in gold, we really have seen no movement in stocks since 1971 as far as price goes. And yet when you look at the values of the S&P 500, it was around 700 to 750 in 1971. It's now today about 5,600. So that's an increase of about eightfold, so up about 800% or so. Are you saying the dollar has devalued by that exact percentage?
In terms of gold, yes. The price of gold, which is real money, has gone up as much as the S&P 500 has. So you end up with no change in the S&P 500 when it's calculated in gold. So yeah, that's what I'm saying, that the real value of a blue chip stock portfolio has not changed at all since 1971. So that those big profits that we feel like we've made in the stock market have all been illusory because we've actually been changing the unit of measurement in a way that makes it look like stocks are going up, but they actually are not. Of course, if you buy NVIDIA stock or something like that only, and it goes way up, you did make money. But in the aggregate, if you bought a portfolio of stocks that represent the S&P 500, which represents the biggest companies in the U.S., you literally made no capital gains in the stock market in the last 50 years.
Very interesting perspective. And, John, I at one time did some research. These numbers might not be exactly right. You can correct me if I'm wrong. But I think the median price of a new home in 1971 was just around $25,000 or so. And with gold at $35 an ounce, it took roughly 700 ounces of gold to buy a home. And today with gold at roughly 2,500 plus per ounce,
you could buy 3 or 4 new homes priced at the median. So that really means that gold has really outperformed just about any other asset class in terms of wealth preservation, doesn't it?
Yes, yeah. Gold was a very good thing to own through all this because as real money, it just holds its value. See, gold doesn't actually do anything. It just maintains. It's an inert rock that doesn't deteriorate or anything with time. And because of that, it's a very good tool for the function of money. It's a very good store of value. And yeah, through the inflation of the last 50 years, gold has actually gone up as much or more than the dollar has gone down. So it's protected your purchasing power throughout that time. And now that we're in the blow-off stage of the fiat currency experiment, where things are just going to get absolutely crazy going forward in the coming decade, gold will probably do even better because it'll not just maintain its value, but it will attract a lot of terrified capital out of other sectors. And so we'll see panic buying probably towards the end of this cycle where, gold, which once held its value, is now actually going up in terms of everything else. So it becomes a capital gains play at some point, like it did the last couple of cycles. For instance, in the 1970s, gold kind of just sat there, and then went straight up towards the end when everybody was panicking. And in the 2000s, when the housing bubble burst, same thing. Gold did okay, and then for the last couple of years, heading into 2012, it just soared. And that wasn't the maintenance of value. That was a big capital gain because panicked capital was flowing into it. And that's kind of the same thing that will happen, well, barring World War III. That's the kind of thing that will happen in the coming, let's say, 5 years when government finances are so over indebted and the interest costs on their debt are soaring, and governments are having to bail out everybody in sight and print huge amounts of new currency to keep all the bad debt that's out there from blowing up. It's a pretty safe bet that a lot of people will be traumatized by what they're seeing, and they'll want to go for safety, which will be gold, and that'll push the price of gold way up. So this is one of those times when something like gold or silver or other kinds of real assets aren't just stores of value, they're actually capital gains plays. So this is going to be a very different market from what we're used to in the past 10 years, but one that's very favorable for the gold bugs of the world. The people who are stacking gold and silver coins will tend to get much, much richer in what's coming.
Well, my guest today is Mr. John Rubino. He has a Substack newsletter I'd encourage you to check out at rubino.substack.com. I'll continue my conversation with Mr. John Rubino when RLA Radio returns. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubergen. I'm chatting today with Mr. John Rubino. John has a Substack newsletter that is must read. You've got to check it out at rubino.substack.com. And we have been chatting a bit about a recent article that John wrote on his newsletter on Substack, A World Priced in Gold. And John, toward the end of last segment, you mentioned that we're entering what you called a blow-off stage as far as fiat currencies are concerned. Can you define that term for our listeners that maybe aren't familiar with it? And maybe more importantly, tell us what you think that looks like for our average listener.
Yeah, the blow-off stage term, I was using it to refer to what happens to the finances of the world right now. Everybody's taken on so much debt over the past 50 years, especially governments, but also corporations and individuals, that it's becoming unmanageable. And so because of that, governments are going to be forced to bail out bankrupt people and corporations all around the world. And a lot of governments themselves are going to go bankrupt. And that's going to lead to the governments that remain. It's going to force them to create so much new currency in order to stave off a 1930-style depression that it'll probably be really inflationary. It'll be like, remember 2022 when we had like 8% official inflation in the U.S. and people's living standards or cost of living just went through the roof. Well, we'll have a bigger, much, much scarier version of that. And that'll lead to a collapse in our faith in a lot of these fiat currencies. There's a term called the crack-up boom in the Austrian School of Economics that refers to a point at which a critical mass of people figure out that it's the government's explicit policy to devalue the currency going forward at an accelerating rate, and they just bail on the currency. As soon as they get paid, they go buy real stuff like oil stocks or gold and silver or really good quality rental houses, things like that, that governments can't just create out of thin air. And so the value of those real things go through the roof, but it's not because they've changed in any way or they're producing any more wealth than they did before. It's because people have lost faith in the currency. And I think that's what is coming as all these bad financial policies and huge policy mistakes of the past 50 years come home to roost. And when that happens, panics capital flows into real assets and it makes their prices go way up. And I think that's what is coming. So, this is going to be a traumatizing time for most people because their cost of living is going to soar. It's going to way outpace their salaries. And so people are going to get, in real terms, much poorer going forward. And that's going to cause all kinds of political instability, as it should. But it's also going to enrich the people who are on the right side of this thing. If you own real assets in a crack-up boom, your real assets get more valuable. So there's an investment thesis here. And that's, I think, the important part of this story is that, this crazy stuff is coming, but it's possible to position yourself so that you at least protect yourself and your family and possibly end up building a lot of new capital through this whole thing. And then at the bottom of the process, when we're trying to rebuild something from the rubble of the fiat currency experiment, you'll be one of the people with capital who can actually make things happen, who can protect their friends and family and who can build new wealth going forward. So that's the intellectual challenge then. How exactly do you position yourself so that you're not just protected, but you're a beneficiary of all the crazy stuff that's coming? And that's the point of my Substack newsletter. We're looking for actionable ideas to actually build wealth during a time that's going to destroy wealth for most people.
So there's so many more things I could talk about there, John, but I'm looking at the clock, and I want to talk about this other topic as well. So I want to shift gears here a minute. At the Jackson Hole meeting, we had Fed Chair Jerome Powell come out and say that essentially the time has come for a reversal in policy, signaling interest rate cuts, signaling more easy money policies moving ahead. Given the numbers, given the economic data, what is the motivation for the Fed going there? And you can say it's political if you want.
Well, this is a really interesting Fed cycle because the Fed has promised to start cutting interest rates in September, but they're doing that with stocks at an all-time high level, houses as expensive as they have ever been, unemployment at a historically pretty low level, and inflation still at the upper level of the Fed's target range. And normally, all those things I just spelled out would be a signal for the Fed to raise interest rates. But they promised to start cutting interest rates here pretty soon. And I think the motivation of that is possibly threefold. And one is that behind the scenes, the Fed is seeing much more scary numbers than they're reporting to the general populace. So they're seeing a slowdown build out there, and it could be because commercial real estate is tanking. It could be because consumers are tapped out and they're over indebted and they can't go on spending like they have been, and the Fed sees that. So the Fed wants to get out ahead of what they see as an incipient recession. That's possible. Second thing is that this is an election year, and the people in charge are probably really leaning on the Fed to get them reelected. And so the Fed feels a lot of social pressure from their peers in Washington, D.C. to keep the economy growing or at least not collapsing until after the election. And then the third is, we're blundering into World War III. We're financing a proxy war on Russia's border and giving the Ukrainians weapons that are capable of hitting, 1,000 kilometers into Russia to kill Russian citizens, civilians, not just Russian soldiers. So, and we're doing similar stuff with China and equally scary stuff in the Middle East. And it's completely possible that geopolitics dominates the next few years, where we get ourselves involved in some shooting wars with some people that are capable of shooting back. And things get really crazy there too. And the Fed wants low interest rates and easy money during that period, because otherwise it's dangerous enough from a financial standpoint to get into a shooting war with a nuclear power. That'll spook the markets big time. But if interest rates are high when that happens, that just adds to the carnage in the financial markets, and that takes us one step closer to that tip over into the abyss of a 1930s style deflationary depression. So the Fed wants to kind of preempt that too. So it's all preemptive. The Fed is not looking at current data or current headline numbers. They're looking at the behind the scenes stuff, and they're obviously afraid of what they're seeing. So that's why the Fed is going to cut interest rates going forward. And it's a dangerous game when you've got a lot of signs that the economy is overheating, like stock prices and house prices. And then you ease into that. You throw even more easy money, gasoline, onto that fire. You're liable to get rising inflation like we had in 2022. And if we go back there, all bets are off, because people know it's possible now. We experienced almost double-digit inflation for a year. So we know that's possible. So the minute there's even a hint of something like that, everybody's going to start acting as if it's a real thing that's going to continue forever, and they're going to preemptively start buying every kind of thing they can get their hands on that is not financial. So we'll go back to hoarding again. Like, remember when you couldn't buy toilet paper at Costco? It's going to be that, but on a much bigger scale. And that's debilitating for a financialized economy. If you've got everybody betting on a crisis, you make the crisis a self-fulfilling prophecy. And that's the risk that the Fed takes by easing too much too soon. So I think we should be paying very good attention to that, because if some of the things the Fed is worried about don't happen, and the Fed is still cutting interest rates really aggressively, then it's possible we go back into that inflationary thing again, but this time with nobody being surprised by it, and everybody not going to let it happen again to themselves, and everybody acting in ways that destabilize the economy. So yeah, we're in very tumultuous times when the government has choices, but whatever they choose in order to try to fix something will make something else even worse. So there's no actual way out of this. There's only a choice of crises. So we choose either to have tight money and risk a 1930s style deflationary depression, or easy money and risk something like the Weimar Germany hyperinflation of the 1920s, and that's basically it, until we have a monetary reset where we just close down the current system and replace it with some other system, hopefully one that is sound money in some way. In other words, we take away the power of the government to just print money out of thin air, and we go back to a system where money is a real thing. And if you want to spend more, you have to get more money. It could be a gold standard, might even be some kind of cryptocurrency standard. We don't know. But that's the end game here. We have this gigantic financial crisis, and the government decides to take the least horrible of their options, which is a monetary reset, and we go back to sound money. So, the end point of that process is good. We're back to a system where we can trust our money again. But getting from here to there is going to be just brutal for most people. So, and they're the people who don't deserve it. The people who trust the government are the ones who are going to be hurt most seriously by the process of currency collapse followed by currency reset.
So, John, I haven't enough time left for maybe just a very quick question. At some point, are debt levels so high, so overwhelming that there's no amount of easy money that will prevent the deflationary collapse? I'm thinking about a statistic that now 3 out of every $4 collected from personal income taxes go to pay interest on the debt. Aren't we close to that reset point? And can the Fed do this? Will it work? I guess is my question.
Yeah, we're in kind of a death spiral now. And here's how we got there. We let huge amounts of new debt accumulate. And then when the pandemic hit, we created a huge amount of new currency in order to keep people from going bankrupt while they're locked in their houses during the pandemic lockdowns. This led to inflation, which forced us to raise interest rates to combat that inflation. And now all that debt that was taken on over the last 50 years is being reset. You know, it has to be rolled over when, for instance, government bonds mature. The government has to borrow more money to pay off the bonds that mature, but it's all happening at higher interest rates. And that means the government's interest cost has gone parabolic. It went from, a few $100 billion a year up to over $1 trillion a year, and it's still going straight up. So yeah, that means a growing portion of what the government takes in taxes just goes to pay interest. And that portion is now growing at a parabolic rate. It's going straight up. And that's the death knell for a government when its interest costs are rising faster than its tax revenues or any other source of revenue, and there's nothing they can do about it. So that's one of the reasons that the Fed is raising or cutting interest rates now too, is that they're seeing the interest costs of the government go up to untenable levels, and they want to lower interest rates in order to prevent that from becoming an unmanageable problem. But they can't. There's no fix for any of this. We're in that death spiral, and it's just going to get worse, although in not necessarily predictable ways. But one way or another, it gets worse from here until it breaks. So that's our next 5 or 10 years.
Well, my guest today has been Mr. John Rubino. Check out his Substack newsletter at rubino.substack.com. John, always a pleasure to catch up with you. Really appreciate you taking time out to have a chat, and I know the listeners do as well. So thank you for joining us.
Thanks, Dennis. Talk to you soon.
We will be back after these words.
Welcome back to RLA Radio. I'm your host, Dennis Tubergen, and thanks again to my special guest today, Mr. John Rubino, for joining us on today's program. If you're just tuning in, I have a box of what I believe is vital information for you to have in today's economy that I would like to send to you. I'll send you the report, Tax-Free Retirement Income Strategies, along with a couple copies of my recent newsletters, along with a complimentary copy of my best-selling book, Revenue Sourcing. All you need to do to get all those resources is visit requestyourreport.com and let me know where to mail all that information. Again, the website, requestyourreport.com. I find it remarkable how ideas, even bad ideas, seem to cycle and reappear. I also find it remarkable how unaware of this phenomenon many U.S. citizens and aspiring retirees are. What am I referring to? Well, Kamala Harris, the presidential candidate for the Democratic Party, recently suggested that price controls be used to control inflation. I'll give you just a bit from a UPI article on the topic. Vice President Kamala Harris will propose a federal ban on corporate food and groceries price gouging when she lays out her policies in a North Carolina campaign speech Friday. According to the campaign, the proposal against price gouging is part of the larger Harris economic policy platform she plans to roll out publicly at a Friday campaign rally in Raleigh. So, without giving you any more from the article, Let me just say that this has been tried in the United States in the 1940s and the 1970s. And not surprisingly, the outcome was the same each time. Let's go back to 1971. That's when President Richard Nixon eliminated the link between the US dollar and gold. At that same time, Nixon also imposed price controls. Now, it is no secret that Mr. Nixon recorded all the conversations that took place in the White House, and you can go review those tape-recorded conversations between Nixon and his advisors talking about price controls, and you'll hear firsthand that Nixon and his advisors knew that price controls wouldn't work, but they also calculated that rolling them out prior to the 1972 election might be politically helpful. Now, the Cato Institute wrote a piece on this topic. Here's a bit from that piece. On August 15, 1971, in a nationally televised address, Nixon announced, "I am today ordering a price freeze on all prices and wages throughout the United States. After a 90-day freeze, increases would have to be approved by a pay board and a price commission with an eye toward eventually lifting controls, conveniently after the 1972 election." Well, there was no national emergency in the summer of 1971. Unemployment stood at 6%. Yet, after Nixon's announcement, the markets rallied, the press swooned, and even though his speech preempted the popular Western bonanza, people loved it too. 75% backed the plan in the polls. However, Milton Friedman at the time correctly predicted that Nixon's gambit would, quote, end in utter failure and the emergence into the open of suppressed inflation, end quote. That's exactly what happened. Ranchers stopped shipping their cattle to the market, farmers drowned their chickens, and consumers emptied the shelves of supermarkets. It's this simple. Price controls eventually grind the production wheels of the U.S. economy to a halt. If you're a business owner, you operate to make a profit. As soon as you cannot operate to make a profit, you now no longer have a business, you have a hobby, and you stop doing whatever it is that you do. And instead of raising your chickens and spending money on feed, if you're going to sell them for a loss anyway, you just drown them. You don't ship your cattle to the market because doing so will cost you more money. As a result, there are supply shortages, and there are probably not many listeners to the program today that remember the 1970s, but shelves in supermarkets were empty. Lines at gas stations were long. This was also tried after World War II. There was rationing and price controls, and once the price controls were lifted, inflation surged. Two different times in U.S. history when the same policy was attempted, and the result was exactly the same each time. It will be this time as well if we go down that road. That's all the time I have for this week. I'll be back again next week. Hope you have a great week.